Good morning and welcome to the BF Anderson Technical Report for December the 20th. This week's going to be kind of a slow week. It's been a slow week. It's been a difficult week. Next week will be the market will be open half day Monday, closed on Tuesday. So Wednesday, Thursday, Friday, things are going to be awful slow. So just kind of enjoy your holidays, and I wish everyone well and a happy new year. Anyway, trend following. The trend is your friend is basically the concept here. You know, as I explain trend following to people, it's nothing more than just an understanding that there are trends in prices that can be better seen and easier seen by using moving averages. So what we're doing here again is we've got the NASDAQ, we're looking at a 25-day moving average, and we're looking at a 50-day moving average. So that's the blue line is 25 and the red is 50. So as we can see here, we basically got a death cross here around the middle of October. At the same time, another indicator we use called trend lines, they also went negative on the 15th of October. However, as we go through these graphs, notice that the small cap stocks really started to get in trouble towards the end of September. So that was the red flag. Now the other red flag was a down day of heavy volume relative to other days. So, the price trend is important, the moving average direction is important, and the amount of volume that takes place on these particular days is important, because you want to determine, are the institutions net buyers or the institutions net sellers, because the institutions are going to drive the market, meaning funds, basically. Mutual funds, exchange traded funds, hedge funds dominate the volume on the exchanges. In other words, I always say it's not your Aunt Sue. So you can see here as of yesterday, we're at another new low for the NASDAQ, came on heavier volume than the prior day, which was a down day. So the trend continues down. Keep the defensive team on the field. Now here's the NASDAQ on a weekly basis, and you can see here as we're getting these weekly rallies, they're coming on somewhat less than average volume, because this line that I have here is the 10-week moving average on volume. So we're looking at this on a weekly basis. Again, you can see the 35-week moving average is flat and actually starting to turn down, and we're seeing another new weekly low on the NASDAQ. Now, again, as we see rallies in the market, it's very important, I believe, to determine if these rallies are the real thing or are they just somewhat of an illusion. Well, if you're getting a bunch of new 52-week highs and you're not getting any new lows and you're getting these rallies, that might be meaningful. But when you see like a 300-point rally in the indexes, like the Dow, and at the same time you're getting more new lows and not any new highs, it would kind of tell you that we call this the leaking boat indicator, meaning that these rallies are to be basically ignored is the bottom line. So as you can see here on the high-low index, this is the number of new highs compared to the number of new lows. We do a new highs divided by new highs plus new lows. So you're taking out pretty much the middle, the stocks on a particular day or that are doing nothing. You pretty much take them out of the equation, and you're only paying attention to the ones making new highs and the ones making new lows, which you then get a ratio. And then we put a moving average on that ratio, and you can see, in November, end of November, we got down to a very low reading, which means just no new highs, and it's a lot of new lows. So here we are. We rallied back up again, looked like we were going to get back above 30, but we've basically failed, and the new lows are overtaking the new highs, and you can clearly see this on this here. This is the New York Stock Exchange. The number of 52-week new lows yesterday were 891, and the prior day to that was 738. This is pretty difficult situation where you're getting a tremendous amount of new lows on the New York Stock Exchange, which is just telling you, keep your powder dry. If you have to do some buying, just keep it light. Don't try to be a hero here. Now again, I want to emphasize this blue line here is where we want to see the number of new lows start to stabilize below 40 But gosh, guys, we're just not seeing that. Now, this indicator here, I've mentioned before, is a long-term indicator. It is a 10-month moving average compared to a 20-month moving average on the S&P 500. You can see where this indicator, back in 2001, early 01, gave you a major bear market signal here. Again, in early 2008, you got a signal here. And also during this little mini bear market in here, which was not anything as devastating as these bear markets, but still difficult. You can see that the indicator does tend to sometimes have a little bit of a head fake where you get the cross, you make the low and then you rally. Well, all I can tell you is that right now, this particular index, we've now got the index below the lower moving average, which is the 20-month moving average. This is the 10-month moving average. So, this is not looking constructive. It's, again, emphasizes the need for caution. Now, just to kind of make the point, there's a theory out there called Dow theory. It goes back to the 1920s, back when you had the railroads and they were the primary way to what to invest in back in the 1920s. You can see here, this is the transportation average. This is, airlines, shippers, the whole deal. You can see where if you compare it, back to the S&P 500, you can see a much, much deeper drop here in the transports than the S&P 500. That's not a good sign. It basically says that when the transports are having trouble, and they're, if you get across in the transports and you get across on the S&P, unfortunately, I think we're in a bear market, but we'll see about that. Things can change quickly. Now, back to the fear greed. We're still in extreme fear. We're getting very high readings on this. As of yesterday, we have a reading of 85. Now, you can see the moving average is at 70.5, but that's just a moving average. That's a 15-day moving average of the put-call ratio. So when the institutions are buying calls heavily, they're optimistic. When they're buying puts heavily, they're pessimistic. So right now they're extremely pessimistic, which this is usually what happens during market bottoms, and this is, when you get to everyone super optimistic, that's usually what happens at market tops. It's nothing more than a pattern that seems to repeat itself. Now, kind of back to the transports, I wanted to mention a couple of stocks in the group. This is Federal Express. Man, really dropping. Heavy volume. I mean, the volume came in, has to be record high volume on this stock. 15 million shares traded yesterday. Stock was down 12%. What's going on with the economy? We'll just have to see. Now, here's another transportation logistics company called XPO. You can see the same thing, and extremely high volume. So the institutions are quite bearish. Now, here's the top five. Now, the top five, let's just re-emphasize here. If you're going to buy any of these stocks, keep it very light. Don't, what I mean by that is if you would normally buy 100 shares, maybe you ought to buy 25 shares. That kind of thinking. But what I am going to continue to say, like last week, we're seeing a lot of technology stocks jump to the front of the list, and they're small caps. So, it's hard to figure because the small cap index has really been having a tough time. But, back to emphasizing the fact that, when you get these difficult markets, you're going to see the really exceptional companies during a difficult market just by their price action. So this is Alteryx, which is a software company. Have not researched it, but it's making the list. Here's another software company. We've actually owned this before. Tableau Software recently made a new high, holding up above the moving averages. Here's Twilio. Again, we took a position in the stock, pretty much had a break-even position in it, and the market just continued to deteriorate. So I just simply said, I got to go back to cash on this. And so I'm keeping an eye on it. I like the story. I like the numbers. I like this company. This could be a future blue chip. This is really an exceptional company. But as you can see, broke below the moving averages. Price action is weak. Here is another software company, a company called Workday. I really haven't researched it, but again, it's jumping to the top of the list. Now, here's a semiconductor that we've been interested in, having to do with 5G technology. Xilinx pulled back, broke below the moving averages. Again, kind of tough situation. So in conclusion, what I'm saying is the market continues to stay in a downtrend. Basically, what that means is that 4 out of 5 stocks are going to go down in this environment. You should be heavy in cash right now. You should have a very defensive posture. And let me know if you have any questions. Be happy to talk to you. Thank you.